There's a restaurant in Los Angeles where the average dinner costs $300 per person. Last Tuesday, a couple walked in, ordered the tasting menu, split a bottle of wine, and paid with a credit card that had $17,000 already on it. They make $62,000 a year combined. They left smiling. This isn't a story about reckless people. It's a story about a system that was specifically designed to make this moment feel completely normal. Americans now owe $1.6 trillion in credit card debt. That number broke the previous record in 2023 and hasn't stopped climbing. The average balance per borrower is $6,000, but averages lie. Millions carry nothing. Millions carry 30, 40, 50,000. And they're not just buying emergencies, they're buying experiences, vacations, watches, couches, dinners they'll forget in a week. Here's what makes this different from every other debt crisis you've heard about. Most people who are drowning in credit card debt will tell you they feel fine. They'll tell you they're managing, they'll tell you it's under control, and in a very specific way, they're right, because the system isn't designed to feel like a crisis until it's far too late. So why do people buy things they can't afford? The obvious answer is that they want them. The real answer is that someone spent decades making sure they would. Let's talk about how this works. You get your first credit card at 22, maybe earlier. The limit is $1,500, low enough to feel safe, high enough to feel useful. You use it for gas, groceries, a few dinners. You pay it off, they raise your limit to $3,000. You didn't ask, they just did it. 2 years later, it's $7,000, then $12,000, then $18,000. Every time you pay on time, every time you carry a small balance, the limit climbs. At no point did anyone sit you down and ask if you can actually afford $18,000 of debt. They just assumed you'd figure it out. Here's the trick. Credit limits aren't based on what you can afford to pay back. They're based on what you can afford to service. Those are not the same thing. Let's say you make $50,000 a year. After taxes, rent, utilities, food, insurance, and gas, you've got maybe $800 a month left over. A credit card company looks at that number and says, this person can handle a $400 monthly payment. That means they can carry a balance of around $20,000 at 18% interest and still make minimums. You will never pay that balance off, not at minimum payments. The math doesn't work. A $20,000 balance at 18% interest with minimum payments takes 41 years to pay off. You'll pay $53,000 in interest alone. But you won't feel trapped because the system doesn't ask you to pay it off. It just asks you to keep paying. Now let's add the other half, the part that happens inside your head. There's a concept in behavioral economics called mental accounting. It's the way people treat money differently depending on where it comes from or where it's going. $100 in your checking account feels real. $100 of available credit feels fake. It's not your money, it's the bank's money. Spending it doesn't hurt the same way. This is why people will agonize over a $15 sandwich but won't blink at a $300 dinner on a credit card. The pain of payment is delayed, separated, softened. And then there's lifestyle creep. You get a raise, $5,000 more a year. Suddenly, the $4 coffee becomes a daily ritual. The vacation upgrades from a road trip to a flight. The streaming services multiply. None of it feels excessive because you're making more, but your credit limit also went up. And your baseline expenses went up, and now that $5,000 raise is invisible. You're not living beyond your means, you're living exactly at them. And the gap between what you earn and what you spend is being filled, silently, by borrowed money. The average American now believes they need to make $233,000 a year to feel financially comfortable. The median household income is $74,000. The difference between those two numbers isn't aspiration, it's credit. But this isn't just about math and psychology, it's about culture. We live in an economy where 50% of GDP is consumer spending. That means the entire system depends on people buying things, not just necessities, things. Restaurants need you to eat out 4 times a week. Airlines need you to take vacations you can't afford. Car companies need you to finance a $40,000 truck at 7% interest for 72 months. And social media made it worse. Because now you're not just comparing yourself to your neighbors, you're comparing yourself to everyone. The influencer in Santorini, the friend who just bought a house, the coworker who somehow always has new clothes. You don't see their credit card statements, you just see the life. So you buy the vacation, you finance the car, you put the couch on Affirm and the dinner on the card, and the concert tickets on Afterpay. Because not buying feels like falling behind, and falling behind feels like failure. Here's the uncomfortable part. The system knows this. Credit card companies don't just lend money, they study behavior. They know that people spend 17% more when they use credit instead of cash. They know that rewards programs make you spend more to earn points that are worth less than the interest you'll pay. They know that buy now, pay later makes a $600 purchase feel like 4 easy payments of $150. And they know that as long as you keep making minimums, you'll keep borrowing. Because that's not a bug, that's the model. Let's zoom out and look at what this actually costs. The average credit card interest rate right now is 21%. 20 years ago, it was 13%. The federal funds rate dropped to near zero during the pandemic. Credit card rates went up anyway, because they could. If you carry the average balance of $6,000 and make only minimum payments, you'll spend over 11 years paying it off. You'll pay $4,800 in interest. That's 80% of the original balance. For context, that's more than most people spend on groceries in 6 months. Scale that up. $1.6 trillion in credit card debt at an average rate of 21% means Americans are paying $336 billion a year just in interest, not paying down balances, just interest. That's more than the entire GDP of Hong Kong. It's twice the budget of the Department of Education. It's money that evaporates into the financial system and never comes back. And here's the part that should make you uncomfortable. That's not a failure of the system. That's the system working exactly as designed. So what happens next? Right now, credit card delinquency rates are climbing. More people are missing payments, more accounts are going to collections, but defaults are still relatively low because most people are still servicing the debt. They're still paying the minimums. They're still trapped in the loop. But debt doesn't disappear. It compounds. And the longer this goes on, the more fragile everything becomes because consumer spending drives the economy. And consumer spending is increasingly funded by borrowed money, and borrowed money has to be paid back, eventually. So why do people buy things they can't afford? Because they can, because the system lets them, because the alternative is watching everyone else live a life that feels just out of reach, and because no one ever sat them down and explained what it actually costs.